Good morning and welcome to this Wednesday, December 22nd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it is Wednesday and middle of the week. We got a holiday abbreviated week this week. Of course, Friday will be closed in observance of the Christmas holiday, which falls on Saturday this year. So no market action on Friday. So we just got 2 more days, today and tomorrow, before we get into what many call, the potential Santa Claus rally from Christmas Day through New Year's. I tend to extend that. I mean, to me, it really is the second half of December. But still, there are others that just look at next week as the week when we get potentially that Santa Claus rally. So maybe the bulls have something to look forward to there. I do know historically from my work that is a bullish week. I don't know that it's any more bullish than the week we're in right now, but it is a pretty bullish week historically. So it's worth noting as we go into the beginning of 2022. Pretty hard to believe 2021 is coming to an end. I mean, it's, I don't know, it seems like forever now since the pandemic hit. We're almost 2 years into this. Stock market still can't quite figure it out. We're all over the place and rotation still crazy, but hopefully we'll start to get a little bit more clarity in 2022. At least that's what I'm hoping. This morning we've got futures kind of mixed. Last time I looked, let's see what we've got. This is as of a few minutes ago, but Dow, we got red now. Dow 46 down, S&P 11 down, NASDAQ down 53. So on a relative basis, NASDAQ getting hit a little bit harder. Recently we've seen the NASDAQ start to pick back up again a little bit versus the Dow and the S&P, and it mostly came from when we hit that key support level just around 15,000 on the NASDAQ, maybe a little bit below. But anyway, we're going to get into all that. For those of you that are new, let me take you over to Earnings Beats. If you want to learn more about what we do and how we look at the market, go to earningsbeats.com and then simply just scroll down. We have a free newsletter, which I think is probably the best way to get to know us, that along with these shows and my blogs over at Stock Charts. That'll give you a lot of insight into the way we approach the stock market. But right here, the free Earnings Beats Digest newsletter. All it takes a name, email address, and hit that subscribe button. It's a 3 times a week newsletter, comes out Mondays, Wednesdays, and Fridays, talking about all kinds of different things, but mostly focused on earnings and relative strength. I can tell you this morning, we talked about a short squeeze stock. I wrote an article about a stock yesterday that at one point was up, close to 100%. And it's the most heavily shorted stock on our short squeeze chart list. 84% of its float is shorted right now. 84%. That's the highest number I've seen on any stock since GameStop. Of course, we know what happened to GameStop. I'm not saying that's what's going to happen to the stock. We never know. But if there's any kind of catalyst, just know that there's a lot of people that have to buy this stock back. So it's not for everybody. These short squeeze stocks can be pretty volatile. But nonetheless, just wanted to mention that. So again, sign up for that free EB Digest newsletter. By the way, no credit card required. You can unsubscribe at any time. So it's a great way to get to know us a little bit. Taking a look at the action from Tuesday, we had the Dow Jones Industrial Average up 560 points, the S&P 500 up 81, the NASDAQ up 360. And you can see on that percentage basis, 2.4% better than the S&P and better than the Dow. And there's that support I was talking about in the short term. So we went just below it intraday on Monday. Bounced back, closed close to the 15,000 level, and then got back up above it with yesterday's gain. Still got overhead resistance on the NASDAQ, trying to get through both these moving averages, plus you've got the trend line starting to look a little bit to me like a bullish wedge, where the highs you can draw a line, and then the lows you draw a line, but it's squeezing. That would be very bullish if we were to break that trend line back up above, say 15.5, 15.6, I think things would start to really look much better technically on the NASDAQ. So we still got a little bit of work ahead of us, but if we can get through that, I think things will start to look better in the short term. Mid caps also did very well yesterday, up 2.6%. Small caps, best of all, up nearly 3%. And that's coming at a pretty good time on both mid caps and small caps, because you can see we were getting down close to some very, very important lows that we made over the summer months. Same goes for the mid caps right down here. So this reversal and move back to the upside was very timely. Like the NASDAQ, we need to break above the trend line. It's a little bit more difficult to argue bullish wedge here, because normally the wedge doesn't go all the way back down to the prior lows like we've seen here. You can see we were still well above the prior low on the NASDAQ. So when I look at a bullish wedge, it's really a consolidation period after an uptrend. It's not an uptrend followed by an entire downtrend back to where the uptrend began. So that's why I probably wouldn't look at that as a pattern there. Also, the bullishness doesn't look the same right now in mid caps and small caps. Look at the AD lines. They're starting to turn back up. Yesterday was a really nice day on small caps, by the way. But we've been in this downtrend now since the beginning of September on the mid caps. And for small caps, it's really been mostly about November and December. But look at the NASDAQ. I mean, NASDAQ's breaking out to a new all-time high on its AD line. That's an interesting development with the stock still in this consolidation and still close to 1,000 points below its prior high. So just keep all that in mind. Looking at the individual sectors on Tuesday, I think 9 of the sectors, 9 out of 11 were higher. I don't remember which 2. I think it might have been utilities and staples were the 2 that were down, but they were just down fractionally. But on the upside, energy did very well. We saw crude oil prices rising, and as a result, energy made a move up almost 3%. Discretionary up 2.6%. Technology 2.5%. Financials 2%. And industrials roughly 2%. So really good action here across all 5 of these. And if you noticed, 4 of these 5 are our aggressive groups. So they've been kind of dormant. I mean, look at discretionary moving lower. Look at financials been moving lower. There's your industrials. Technology a little bit better, but even that one pulled back and hit its 50-day moving average. So leadership, is it just a one-day thing? Is it more than that? Well, we're going to find out. But at least we had a pretty good day yesterday. Saw some of the growth names doing much better. And we'll see whether or not that sticks as we finish out this week and head into perhaps the Santa Claus rally next week. We'll see. All right, 10-year Treasury yield. As far as economic reports, we did get the Q3 GDP final estimate a little bit ago this morning, probably maybe 35, 40 minutes ago. And it came in better than expected. It's been kind of hovering around that 2.1% previous readings. We were expected to have 2.1% growth. It was 2.3. So it did come in a little bit better than expected. Later this morning, we have December consumer confidence. November was 109.5. December is expected to jump to 110.7. And then November existing home sales will also be out later this morning, 10 a.m. And we're expecting a rise there. October was 6.34 million units, and we're expecting that to jump to 6.51 million. So 6.34 to 6.51. Couple of announcements before we get into any further charts. Just want to let you know this is the last Trading Places live show of this year. Next week, we're all going to kind of take some time off, spend some time with families, do a little traveling. Hopefully, all of you are doing the same. Kind of get away from the market a little bit. Of course, with all the volatility, I'll still be checking in. It'll be more of a skeletal week for us. You won't be hearing from us as much, whether it's through customer service, email, whether it's through the daily market report. I will probably send out 1 and maybe 2 daily market reports next week. Remember, the market will only be open 4 days because we got New Year's. The observance of New Year's will be next Friday. So we've got 4 market days. I'll send out at least 1 middle of the week. But if things are crazy, I'll probably send out a second one. As I mentioned, I think in one of the DMRs, our daily market reports, there's always a Starbucks somewhere, right? And I'll have my computers with me. So I will kind of play it by ear, but just know that we're going to be on vacation, many of us. And so we'll probably have a lesser schedule next week. As I mentioned earlier, Christmas holiday is observed this Friday. So market closed on Friday. And then I want to also point out, we haven't gotten anything out yet, but we are having our Market Vision 2022 event. It will be on Saturday, January 8th. It will most likely start around 8:30 or 9. I imagine it'll go on for about 4 or 5 hours. It will be recorded, so you'll be able to listen to it at your leisure. We'll be having more details as far as how you can attend and so forth. That'll be coming out very shortly. All right, let's move on to the 10-year Treasury yield. Let me give you this quick update, make sure we got the latest. So it's 1.457. So we're seeing a pullback again. I just think right now the yield's going sideways. And like I've been saying recently, I don't know what Jerome Powell's thinking at the Fed, talking about 3 rate hikes, talking about, everyone's talking about inflation, runaway inflation, which, hey, the numbers support that. But I can tell you this, the bond market's not overly impressed with all those numbers. You would think everybody would be selling bonds with that on the horizon, meaning that yields would be rising because the price of Treasury bonds and yields move inversely 100% of the time. So if you see the yield flat, that means prices are flat. If you see the yield rising, that means prices are dropping. If yields are falling, that means folks are moving into bonds. And we're actually below where we were when the Fed made its announcement in the yield. So we went down. Well, first we went up initially right after the, maybe for an hour after the announcement. Then we went down. Then we came back pretty strongly both Monday and Tuesday of this week. And now today we're back down. But right now we're below where we were when the announcement came out, or maybe we're right about where we were. The bond market doesn't seem to be too worried about inflation or the Fed's rate hikes. To me, this is a pretty strong signal that it's more hype than anything. And let me just tell you that it's not unprecedented for this Fed to come out and announce rate hikes and then not do them. We saw that at the end of 2018. In fact, if you go into my articles, or just go to articles and go down to the Trading Places blog, go to archives. It was the fourth quarter. It was December of 2018. Pull that up, and somewhere, here it is, How the Grinch Stole Christmas. Almost the exact same time of the year, right before Christmas. And the Fed announced that they were going to hike rates twice in 2019. And I looked at the reaction, and I mean, you can see this. I think I was pretty clear. There won't be any rate hikes in 2019. Not only were there no rate hikes in 2019, but in July of 2019, the Fed lowered rates. So what they're saying, to me, reading the charts is so much better than trying to read someone's lips. I don't care what anyone is saying. Tell me what you're doing with your money. And when you get into this, you start looking at what the bond market is saying. I think that's a really big part of analyzing the stock market. I think sometimes it starts with the bond market because interest rate policy is going to dictate a lot with the stock market. It's all about earnings and interest rates, to be honest. I mean, it's really those two things. And so anyway, I just wanted to point it out. I think we have a similar situation now. I mean, we definitely have inflation rising. I'm not saying it's not. You can go to the grocery store, you can go anywhere, go look, fill up your tank with gas. I mean, everything's going up. But how much of it is going up because of supply chain issues? And how much of it is going up because of an inflation problem, long-term inflation problem? I think it's the former. I think it's a lot of supply chain issues. And I think as we work through 2022, I believe we're going to start seeing the inflation rate coming down. And then the Fed's going to pause, because I don't think I don't know that the economy is going, I think the economy is going to be strong. I don't know if it's going to be as strong as this year. I think, we'll see how. I'm not a healthcare, I'm not in that field. So I can't tell you how the Omicron variant's going to evolve. And, we got some economies. I think the Netherlands shut down again, and they're going to reopen in January sometime. I have no idea how that's going to evolve. But I think the economy is going to reach a point where we're going to kind of level off, maybe even move a little bit lower. I think demand maybe at some point in 2022 starts to level off, and all of a sudden supply is there again, and there's not going to be any inflation. My opinion. You can disagree with me. Anyway, let's keep moving. Got a lot to still go over. So here's the Dow Jones U.S. Small Cap Growth Index. And this is one that I've been following and do follow quite a bit, mostly because I'm a proponent of growth stocks. And they're not going to go up all the time. In fact, 2021 was not a particularly good year. You look at growth year and you say, what do you mean? It's been going up, right? Well, it's not that it's going up. It's that I could have put my money in the spider and been golfing every year last year or every day last year and been much better off. Here's growth stocks versus the S&P 500. So the growth area within the S&P, especially small and mid-cap growth stocks, didn't do very well. And it was the constant rotation. It was the battle with inflation. It was a lot of things going on, but primarily it's just all of this rotation and the uncertainty. This is when we had the big inflation scare, February to May. That's where all of a sudden the numbers started jumping. And you can see that's where growth stocks did the worst on a relative basis. Then they went long for the ride. And now here in November, we got inflation talk. We got the Fed talking about raising rates. And so those two things aren't great for growth stocks. But I'll also tell you this. When inflation peaks and starts coming back down, historically, you want to be in growth stocks. So the threat of inflation, again, I don't think inflation is going to be a big problem, but the stock market could care less whether I think something's going to be a problem. It's going to do what it wants to do in the near term. And the headlines are going to be out there. People are going to get scared. Nothing I can do about that. I just tell you what I think. And I think growth stocks are going to explode higher in 2022. I don't know when it's going to be. I think we're in a challenging period right now, and I think we're probably going to continue to be. I don't know that we've seen a relative bottom yet in growth stocks, just because we've got the threat of higher interest rates. We have the threat of inflation. And the media is going to be all over it every time we get any kind of report that talks about it. So I don't know that we've quite reached bottom, but I can tell you, for me personally, I'm building positions in some growth stocks that I like Tesla, like Zoom, Etsy, getting hit so hard. There are other stocks, but my position, even though I'm, pretty short-term trader, is it's very difficult with rotation. I can time sometimes market tops and bottoms pretty well. But timing the rotation is a different story, and it's really not easy to do. And so sometimes when I think an area is just getting hit too hard, I will I don't want to call it value investing because it's growth stocks. You don't value invest in growth stocks. But when they're getting hit during a period where I believe they're going to go higher, it is a little bit of kind of value investing because we have no momentum in growth stocks to the upside right now. And normally I like to invest or trade with growth and momentum. And right now we got the momentum going to the downside. But if we go back to that regular chart on the Dow Jones U.S. Small Cap Growth Index, you can see that we're down into an area that's pretty important support. I mean, not only did we take out the lows that we saw earlier in December, we took out the lows that we saw back here in October, the August low, of course, that was already pierced. And then we even on an intraday basis went down and tested the low from back in mid-July. I mean, if we don't hold here, there's no major support levels until you get all the way back at the beginning of the year. I don't know that we're going back down there. I'd be surprised. I think maybe with this low, this recent low, it looks like maybe we have a positive divergence. So if we can get back through the 20-day EMA on this growth stock index, I think maybe we can make a run. And maybe this is the Santa Claus rally next week. Maybe we make a run to 7,600, 7,650. And then kind of play it by ear and see what and I don't even know we get there. I mean, futures are down. Maybe we go right back down here. We do have to try to negotiate this 20-day first. So those are just some of the things I'd be looking at. Let's see, in the news today. So let's first talk about Tesla. So Tesla CEO Elon Musk announced he's completed his sale of 10% of his shares. Now, what they don't tell you in the media, they're always, they've been beating down Tesla recently, talking about how Musk is going to be selling his shares. And he's selling his shares. What they don't tell you is that he's also exercising options. And so even though he has quote unquote sold 10% of his holdings, he now owns more shares than he did back when he started selling because of the exercising of options. A lot of the insider sales that people talk about, I ignore, because a lot of CEOs, a lot of management receive options as part of their compensation package. I mean, if somebody said, here are options, you can have options, and by the way, you're going to get taxed on them and everything else, what are you probably going to do? You're probably going to exercise, and you're probably going to sell some of your stock. Why? Well, maybe to pay your bills, maybe to pay taxes. The other thing that Musk said is, what do you have, $11 billion tax bill? Well, that's probably a good reason to sell some stock. Pay off your taxes, pay some of your tax bill. Anyway, I think sometimes the insider selling is completely overblown. I think you have to be careful. Now, if Elon Musk came out and said, I'm going to sell half of my stock, yes, I would take notice. To me, that is a significant sale. That's not to meet your tax obligation. That is something bigger. I mean, I'd need to know what the heck is going on with something like that. Anyway, Tesla, with this now new announcement, quote unquote announcement, that he's done selling, I think it was up $30 pre-market today or something. I don't know, maybe it's pulled back from that. Yeah, it's still up $30. So Tesla actually came down. You see here, gap support. Also, the breakout occurred at about 890. So it went back down and tested the breakout level from right here. I don't know if it goes higher from here, if it consolidates, but one thing I'll say is that during all this selling, look at the AD line moving higher. I think the stock continues to be accumulated. So if you're just looking at price action, you're not paying any attention to the AD line, you might think, wow, the stock's downtrending, it's in a lot of trouble. And hey, maybe it is, but I don't think it is. I think that this has been an opportunity on this pullback near support to build a position in a really good company. And especially if I'm right about growth exploding next year. I think Tesla could be 2,000 in 2022. It's 938 right now. And I say that because I think it's been unfairly beaten up a little bit because of these inflation concerns and the threat of higher interest rates. I think if that starts to go away, I think Tesla will explode. Just my opinion. I got no crystal ball. I could be wrong. Trust me, I've been wrong about many, many stocks. I continued to believe Zoom was really good stock for a good part of 2021 before I finally threw the towel in and just waited for a while. And now, again, I think it's starting to show signs of accumulation. We'll see what happens there. Other stocks in the news, Caterpillar upgraded at Bernstein from market perform to outperform. 80 line weak, relative strength has started to pick up again, but it's in a very weak group. So the group has been going down versus the S&P. Yeah, Caterpillar starting to show a little life against its peers, but it's not showing life against the S&P 500. So I don't know about this upgrade. I think it might be a little early. I'm not interested in Caterpillar at this point. Alibaba downgraded from overweight to neutral by Atlantic Equities. I just want to congratulate Atlantic Equities on finally recognizing that the stock's been downtrending from $270 to $110. So great call there on downgrading now from overweight. If you can tell, I got a little sarcasm in there. I'm not a big fan of these Wall Street firms. You'd think that they would downgrade at some point over the last year. Really overweight. And the reason, if you're new to earnings beats, the reason I get sarcastic with these Wall Street firms is that these are the same firms, many of them, that have market making operations. So they're trading stocks that they're also issuing buys and sells on. I think that's the biggest conflict of interest in the history of stock market investing. And yet that's the way our system works. So you got, I mean, can you really trust a Wall Street firm that comes out and issues a buy or sell? I mean, if they tell you to buy and you buy, their market making unit's going to be selling it to provide liquidity. Anyway, done with that rant. DRI, this is Darden. Darden Restaurants going sideways here for a while, but Stifel Financial has upgraded it from a hold to a buy. I'm not really seeing anything, relative to the restaurant group. It's closer to a 52-week low than it is a 52-week high. I think it's got some work to do. It did bounce yesterday off of some support. Maybe we make another run for 155, 160, but I don't know. I think there are other stocks that I'd be more interested in. Williams-Sonoma also upgraded. Loop Capital upgraded from a hold to a buy. Stock's been going down with many growth stocks here over the last month. It's hard to say which stocks are going down for a reason and cause, and which stocks are just getting caught up in this low tide coming in, because so many growth stocks have just been sold indiscriminately that some of them are presenting, I believe, a great opportunity. Others probably won't come back. And so trying to differentiate between the two is not exactly easy to do. But I do, maybe what you do is go back and look at a long-term chart on some of these companies and get a sense of what they've done over the last 10 years. Stocks that have gone up and down like a yo-yo and really have done nothing over 10 years, probably on this pullback wouldn't get me that excited. But if a stock has a history of bouncing back from these types of pullbacks and going to new highs, then those are ones I'd probably be narrowing my list to. Anyway, Williams-Sonoma downtrending versus the specialty retailers. But you can see actually on a relative basis, it's down near pretty key support area. It's down close to some, fairly good price support. This one, I'm not rushing in, but while it's been going down the last week and a half or so, look at the AD line turning around. So it's definitely giving more bullish signs than some of these others that I talked about. Let's see, what else do we have? Well, let's go ahead and move on to earnings spotlight. I want to talk a little bit about BlackBerry first. So they came out, they beat their earnings estimate. They just reported earnings. Expected to lose 6 cents. They actually came in break even. Now, its group has been pretty strong. It's been, relatively strong. You look at the group relative to the S&P 500, it's at a 52-week high. And yet up to this point, BlackBerry has been trending lower and lower versus its peers. And then they come out, they beat earnings, they beat their revenues. I think they issued a little bit of cautious guidance going forward. And even though they beat and they're in a strong group, stock down 3.5% this morning with their better than expected revenues and earnings. Just can't get out of their own way. BlackBerry's been dead money for quite a while. I would stay away from it. All right. Let's go back to the chart there. Next up, AIR. This is AAR Corp. AD line trying to break to about a 4-month high. You can see the volume has been picking up a little bit lately. When it's been for the last 5 days, it's finished near the highs, or at least in the upper half of its candle. So it's starting to show some pretty good signs. They did beat their earnings 53 cents versus 52. So we'll see whether or not we can get through that 39.5 area. That's the resistance that we need to get through. Those were two that reported yesterday after the close. Another one that reported, smaller company, reported after the close yesterday, California Amplifier. Stock's been downtrending for a while. Look at the relative weakness. And this is in a group that's been doing well. So should we have been surprised when California Amplifier came out and missed their earnings yesterday? Expected to lose a penny. They lost 8 cents. And I believe stock was getting hit pretty good. Down 21% pre-market. This is the reason why I would not own any stock heading into its earnings report when its relative strength is doing this. And when its group has actually been performing well and it continues to underperform its peers in the S&P 500. Yeah, it's always a bigger risk, in my opinion, to hold a stock like that. Other companies, couple of others. I know we just opened the market. I'm running just a little bit late, but hey, this is the last show of 2021. So we'll run just a couple extra minutes here. CarMax has opened up higher today. They did beat $1.53 versus $1.48. Cintas, they also beat 276 versus 262, but this stock's actually pulling back today. Paychecks, 91 cents versus 79. It's breaking out to a new high. AD line looks pretty strong. And look at Paychecks relative to software, moving up near a 52-week high. Now, this is the type of company that if I was going to hold into earnings, this would be it. A company that is showing relative strength. That means to me that Wall Street likes the company. And now we're finding out why. They gapped up, probably going to head higher. But some of that, I guess, will be dependent on the overall market. The three you must see. Let's wrap this up. I'm going to start off with Penn National. So this is in the gambling area. It's been moving lower. I'm going to pull up a different chart on this stock. I want you to see the positive divergence. So it's been going lower and lower. See these two lows? Look at the PPO. We actually started to see a positive divergence right here. Had one more move up, pulled back, and now we have a positive divergence. Now, what this normally would tell me from a trading perspective is that the odds of getting through that 20-day moving average are much better. Let's see. I'm going to say this is probably, there are a couple of areas. First, there was this support right here, but we went down, we broke it, we went back and tested it, and then broke down again. So this is more of the area that I think we could maybe get back to. And as the 50-day moving average comes down, I wouldn't be surprised to see Penn make a run for maybe $56, $57. Based on that PPO. So this is a stock, I think, poised for possible Santa Claus rally. That's what the positive divergence is telling me. And so if we can get it close through the 20, you might see some buying really step up here on the stock. The next stock is HST. This is Host Hotels and Resorts. Here we got a double bottom in play, and here's the high in between. So to me, that's a pretty critical area of resistance. So if we can get up through 17, 17 and a quarter, I think we have a reasonable shot to go back up here and challenge this 18 and a half area. And by the way, while we're looking at it, if you ever own a stock that's going up and looks like it's breaking above a major resistance level and then leaves a long tail above and comes back down and closes below, I get this question a lot. When do I sell? As a trader, I would sell on that candle every time. First of all, that's a shooting star candle. It's like an upside down hammer. So when you get that, and especially with a failure at resistance, normally I would say most times, nothing's a guarantee, but most times you're going to go lower. And I just don't want to take that risk. So that would be a sale. Or sell, in my opinion. Here, look at this. We actually had a false breakdown to the downside with maybe not a hammer, more of a doji, pretty small move back, maybe a spinning top. Anyway, we got this big move back up to the upside yesterday. Now, can we get through? That's the question there. Last one I have here is Expedia. And man, talk about a company that has really changed the look on its chart in the last 3 or 4 days. These three candles right here, very strong. They're like three white soldiers, very bullish, closing near the high. Look at the AD line. Suddenly, with those 3 days, breaking back to what looks like today could be a new 52-week high on the AD line. So I know that there's a lot of talk about, Omicron, but if Omicron was really going to shut things down, Expedia would not be doing this right now. So that's just another one of those signs. Watch these travel stocks. We're seeing airlines moving higher. We're seeing cruise lines moving higher. We're seeing Expedia, bookings, these travel companies moving higher. If they break out, watch their 52-week highs. If they break out, I would not be banking on this virus doing much economic damage in 2022. So if we get rid of that, then it just comes down to the inflation issue and what's going to happen there, and we'll see what happens. I've kind of given you my thoughts on it. I don't believe it's going to be a problem. I think it's going to continue to be in the headlines for the next several months. I just don't think it's a long-term problem. And when Wall Street you're going to see it in the growth stocks. When Wall Street starts to believe or starts to really jump in to these growth stocks, that's when Wall Street is completely ignoring the claims of the Fed that they're going to be raising rates because of, inflationary concerns or whatever. I don't believe it. We'll see. Anyhow, that's it. Let's see what the market's doing. See if it's still down with its earlier futures. Now we kind of bounce back. Dow up 8, S&P flat, NASDAQ down 21. Small caps down a point, mid caps up 2. The VIX, and this is one of the problems right now. I'll just tell you this in the market. And one of the problems with the rotation and the sudden movement, when you've got a VIX that's already elevated, in the upper teens or into the 20s, it's telling you that the market's very nervous. And so that's what's driving things crazy in both directions. I mean, I wrote an article, and this is the last thing I promise, then we'll wrap up. But I wrote an article probably a week or two ago, and it was talking about the VIX, how when the VIX went up recently, we only have a couple of days here on this chart. But anyway, the VIX went to like 35 or 36 when the market was selling off really hard. A week later, we went from a VIX of 36 to an all-time high on the S&P 500 in a week. I'm pretty sure that's never happened in the history of the stock market. And that's what we're dealing with right now with this rotation and this craziness in the market and the rotation between growth versus value, large cap versus small cap. I mean, all of this has made 2021, in my opinion, one of the more challenging years for trading. Now, for buy and hold, heck, you just bought the S&P 500 and you're fine. Really not a whole lot of volatility throughout the year. May not have even noticed. But for those who trade, it's been a different animal for sure. Anyway, that's it for me. Again, want to thank everybody for supporting us in 2021. Thank you for watching the shows, following my blog articles. You can go over to the articles here. I've got 3 different blogs that I write on if you're not familiar. Go down to Trading Places with Tom Bowley. You can go to Don't Ignore This Chart. I try to put a chart in there every once in a while. And then Chart Watchers. Both John Hopkins, my partner, and I, we both write in Chart Watchers. One of us will be writing in there every week. So be sure to check those blogs out. But again, just want to thank you all. Happy holidays to everybody. Be safe. Happy New Year. And for those of you members of Earnings Beats, obviously we'll be back in touch with our daily market report and so forth, between now and the end of the year. But for the rest of you, hey, we'd love to have you come over and try us over at Earnings Beats. You can just go over to Earnings Beats. We have a no-cost 30-day trial. So you sign up. You do need a credit card for that, but there's no charge. And before your 30 days runs out, trust me, we will let you know that your trial is running out. We're not going to say, boy, I hope they don't notice. We don't want your money if you don't think that our service is worth it. So you can check us out. We'd love to have you. Try us as we go into a new year. I think, you'll enjoy the service. Anyhow, that's it for me. Again, everybody have a great rest of your year. Be safe and see you next year. Happy New Year and happy trading.